Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. When looking at buying your first property or even building your own property portfolio, there is much more than just saving up enough money for the deposit. Today, I'm joined by Arena McLellan, founder of the Property Arena, a property education and consultancy business that has a strong passion for busting the misconceptions of property and teaching people the right way to buy. With an extensive industry expertise in banking, lending, loans, and property education, Arena explains all the ways to best get into the property market. She believes it's all about understanding what works best for you, how the lending system works, and finding an expert to help get you the best property for your situation. Arena is also an investor on her way to adding her 8th property to her residential and commercial property portfolio, all by the age of 23. Well, welcome, Arena, to the show. How are you?
I'm excellent, mate. What about yourself?
Very good. It's busy time of year, but it's good that we've been able to chance to have a chat because I think this is a topic that will really interest people about property. Anything about property interests people. So maybe. I know you work for one of the big 4 banks. Maybe give us a bit of background on what your role is with them.
Yes. So I've been with the bank probably close to half a decade now. And so I've gone through a wide variety of different types of roles, ranging from home loan retention up until small business banking, up until like more types of niche lending. So at the moment, I do business banking, which entails home lending, commercial lending, business lending, and even lending to franchises, lending to our self-managed super funds. So it does get quite in-depth. And basically, I've just used that knowledge to now make my own business.
Okay, and excellent. We'll talk a bit about that because that sounds like an exciting new chapter for you. And anything we talk about property, people are just interested. And what we've seen, especially in Sydney, the last few years, is this huge boom in property prices. It must have been a very busy time for you.
Oh, yeah, of course. Especially for a lot of the investors. So during the past 2 years, we've had a lot more applications, mainly for purchasing investment properties. But even then, the first home buyers really took advantage of like the all-time low rates in order to borrow a bit more, which in turn like increased all of the property prices. But it is what it is. Things happen.
Okay, do you want to explain a bit more to someone who may be in their 20s or 30s and is going to be their first property? They do have access to that first home grant. So do you want to give explanation of what that's all about?
Sure. Well, what people don't actually know is that there's actually a variety of schemes and guarantees. So the most commonly known one is first home buyer, where you need to be over 18 and you can potentially borrow up to 95% of your property purchase, in which there's a guarantee in place by the government in order to do so. But those are quite limited. I think from memory, those are limited to, I think, 30 to 35,000. But there are actually other guarantees which may be a bit more specialized for people in certain circumstances. So there's, I believe, a family home guarantee where if you're a single parent and you have a child, and either you can be a first home buyer or actually have previously owned a property. Plus, there's a bit more criteria to that. I believe you can actually purchase a property with only 2% deposit. So that scheme's mainly to help around like single parents where obviously it's a lot of responsibility, time and care to look after a child. So that's actually a really good scheme. And there's also other schemes such as the first home super saver scheme, where you can actually make additional contributions into your super, which, depending on what your tax bracket is, can be a lot more tax effective. Of course, you need to talk to your accountant about that. But you can actually use those. Yeah, but you can actually use those funds as a deposit for your first property as well. So like there's so many schemes, so many guarantees where the government's literally trying to help you get into the property market. So I don't understand when like people say, oh, it's so hard to get into the market when there's so many opportunities available to you to make use of that.
Well, yeah, and I think people do say that, how hard it is. And I think part of the frustration is, even if you've got the loan, to turn up on a Saturday at an auction and just always seem to be getting outbid. So that can be very frustrating for people. But that's one of the things I think, using experts like yourself for the lending, but also using experts for property advocates to go find the property. There's always better people to do this than you trying to do this all on your own. So, but maybe we start with where your specialty is and helping people to get prepared to get the loan, because a lot of people unfortunately do it the other way around. I found this dream property and then they go to the bank to sort of say, well, what do I want to get a loan now. So if you were sort of advising someone and they're on this journey before they find the dream house, what are some of the things you would sort of recommend for them to look at?
Yeah. So first things first, don't go on realestate.com as your first point of move, because in my experience as a banker is that a lot of customers, they do find their dream home, and then they come to me and then they can't even afford to get the loan. And so I find that what a lot of other property experts fail to actually stress on is the importance of bank finance. I find a lot of experts really dwell on the cash flow position, on sourcing the property, which, don't get me wrong, like those are extremely important factors, but those mean nothing if you can't get the bank finance for it. So so being that I have a really heavy and extensive background within all types of banking finance, that's actually the specialty that I do bring. So for my business, which is the Property Arena, which we do property education for first home buyers and for new and experienced investors. We, of course, focus on all the important factors such as property sourcing, property cycles, all of that. But we actually really give you an in-depth point of view around bank loans, how to get a loan, what are the criteria, what are even like some mitigants to overturn certain particular policies. Because just because one banker tells you no doesn't necessarily mean that it's a no. So we really go in depth within my seminars for that, to actually understand like what are the inner workings about the credit processing, and essentially how to maximize your borrowing capacity and how to make use of that most effectively. Because just because you can borrow $1 million doesn't mean that you should go off and buy $1 million property.
That makes perfect sense. And we will provide links to your Property Arena, which is a great name, by the way, and also to your seminars and your website. So we'll provide that all in the links at the end of this. But what are some of the real simple mistakes? Like, I know, for example, when I was helping a client and they just didn't realize, well, won't they just look at my salary and look at what net savings I have, and that's it, which is what they did when I was first getting a home loan, whereas now they go through all your expenses, don't they? Do they look, say, 1 month or 3 months? What's your experience?
Okay, so expenses are actually really, really important. So a couple of years ago, there was this big crackdown amongst NCCP law and regulating, where all the banks went really, really tight, really, really strict. And there was this big kind of zone in about expenses. Now, within the banking world, we call it GLE, which is general living expenses and expenditure. Right. So typically we would look at roughly 3 months, depending on the type of risk that customer may be to the application. So when I say by risk, so example, say if you work casual, or say if you don't really have that much in savings after you buy the property, well, then that's when the bank or the banker may zone in to potentially up to 6 months. Or say if we see continuous transactions for things like alcohol, gambling, then that's when we might look at more so a broader picture. Because say, for example, we have seen that for the past like 3 weeks, like you've bought thousands of dollars worth of alcohol, well, then your answer may potentially be, because, I had a big like 50th. So like I was going around trying to buy, alcohol that's on sale. But from a broader picture, from like a 6 month viewpoint, it's like, okay, well, you actually don't buy alcohol at all. It was only within that time frame. So another common aspect of expenses, which a lot of people don't know, is that you can actually advise your loan officer or banker about large once-off expenses that are non-reoccurring. And I want to stress the importance of this because, example, say if you went ahead and bought a $5,000 TV, that's going to come up on your statements, in which through all the programming and all of the data, well, then it'll essentially calculate like what's your average monthly expenses. So if it's taking into account the $5,000 TV, which no one buys on a monthly basis, then that's going to increase what your actually like average monthly spend is. So what I would recommend to people is that make a list of all the large once-off non-reoccurring purchases and give that to your bank and say, hey, look, these are actually not part of my living expenses. They were just once off because of XYZ. And we're more than able to actually exclude those when we factor in what your living expenses are. And that will make a big difference to a lot of people, which this is a tip that unfortunately a lot of people don't know.
Yeah. And I think you're saying also, as you said, if I'm getting from this, that if you're wanting to get that loan, maybe this should be a 3 or 4 month plan before you actually apply for the loan, because you can have all your expenses. You can make sure, well, yes, you can explain a one-off, but it'd be even better if it's not actually there.
Yep.
So, if there's things you're trying to one-offs or plan, maybe leave that till after you get to the loan. But, you should be thinking this is a 3-month project to get your expenses all in order to make sure that they're presentable to the bank. So a lot of people are also saying, if they're starting out, okay, I'd love to get my first home, but where my parents were, where I grew up, that's just not affordable anymore. So if they lived on the beaches and so that's not there, I still may want to live there or may want to live in a city, but I can't afford that. So I may do what's called rent vesting, and you would see a lot of that. That's probably maybe a work, because I think for a lot of, especially millennials, they are living where they want to live, but then still wanting to buy an investment property. Is that something you're finding a lot of?
Yes, and I'm actually a very big advocate for that. So I do it myself. So when I talk to a lot of first home buyers, they're under the impression that they can choose to live in like $1 million house in like this pricey, like inner west suburb, in which like, no, just because you're on decent income, just because you have somewhat decent savings doesn't mean that you can actually afford that. Right. So I feel that within our generation, everything's about short-term gratification, like doing things as fast as possible. When it comes to property and living in like where you want to live and what your desired locations are, sometimes you just need to pump the brakes. Sometimes even if you are able to afford in a certain area that you want to live in, it may not be the best time or best investment for you. So that's why I'm a big advocate on buying where is essentially going to make you money, or where it is in a growth area. And say if you want to live, example, in Bondi, would then rent in Bondi and then buy in growth areas. So unfortunately, like, people fall in a big trap where the more expensive a property is, then the more money I'll be able to make from it. And that's completely incorrect. So that's why it's always good to do your homework. Don't put all your eggs in one basket. So as I said before, some people think that because they can borrow $1 million, that they should go off and buy like a $1 million property. But realistically, you might be better off buying three $330,000 properties, give or take, where one, you've reduced your concentration risk. So when I say that, say if you buy $1 million house, say if it floods, say if it burns down, then all your eggs were in that one basket. Whereas if you had $1 million and use it to buy 3 properties, then if you lose one tenant, say if there's a flooding for one of the properties, then you've reduced your risk by 33.3%. So for me, when it comes to investing, or even if you're looking to buy your very first property, you really need to think about risk. And risk often isn't spoken much, like when it comes to property experts and investors. Again, like the focus is, of course, like trying to find a cash flow positive property and like trying to source a really good property. That's great. But you also need to think about, well, hypothetically, say if things don't go to plan, then what risk mitigants do I have in place? So that's another thing that we really stress on, and what we pretty much educate all of our clients on is that sometimes you do have to have a backup plan, and that could be in the form of your loan structure. It could be in the form of, okay, well, rather than buying just one property, use that same amount to buy 2 or 3. So again, like, everything's a very tailored conversation. Just because I'm giving these examples now, it may suit you, but for John or Bill, it may not be a suitable strategy. So that's what people need to come to understand, is that just because one expert says that, oh, well, I did things XYZ, doesn't mean that XYZ is going to suit you. Because everyone enters the markets at different times. Everyone's on different forms of income or has different sources of income, which essentially affect like how much they are able to borrow. So everyone's in a completely different position. So that's why you just need to be educated in a well-rounded manner on multiple different types of strategies, and then make your choice from there on, which is what we like to focus on.
Wow, that was a lot. There's a lot there.
Sorry.
Thank you, Arena. That
I
was
went on a rant.
I think, and you just raised so many great points, and I just think you can see how passionate and how much you know on this subject. So, no, thank you for that, because I think the listeners will really appreciate. But I think you've raised, because it's one of the things I really do talk about that a lot with clients, and say about $1 million property, or say a $2 million, maybe that should be 3 properties rather than one big property. But you've actually explained it in a way I've not really thought about before, about the risk factor. Yes, if you lose one tenant, well, you still got 2 other properties that got tenants, or even worst case, one burns down. You've got the others where if you put all your eggs in the one basket. So that diversification with property makes a lot of sense. So, but it's also, from my just looking at interest rates and the returns from a financial point of view, you can, for a $300,000, $400,000, $500,000 property, find growth areas, but also getting rental income of say 5%. That's very hard to get on a $2 million property. You just can't get that type of, you can't get that income return. So even if you could borrow that in one property, so it makes sense from a financial point of view, but absolutely from a risk, spreading that risk and the diversification, that makes a lot of sense. So, if you're talking about rent vesting or rent to that, it's also for a lot of people, I imagine they say, oh, well, I live in one part of Sydney, therefore I want to buy an investment property in that same part of Sydney. It's not about that. It's really about growth and return, isn't it?
100%. And so I feel a lot of people are scared to buy interstate when, say, if you're living in Sydney, then sometimes interstate is where the money is. Because what people don't know is that every state has its own property cycle. So the phase that Sydney are in currently, it's not the phase that Brisbane may be in, or Adelaide or Perth. So everything's got their own cycle. So so if you're someone where you're not on very good income, or like you can't borrow that much, then don't be of a mindset where, okay, well, I've got to save hard the next 3 years so that I can buy in the area that I want. Whereas, well, you're better off buying something in a different state that you can afford now, and then over the next 3 years, whilst you continue to save, you also have equity growth. So it's like you have a backup plan to what the original plan is, and plus you have a growing asset, and plus you have pretty much someone else paying your expenses and paying like your interest payments for you. So yeah, I feel like that's a very stuck mentality where it's like, okay, I need to have a set amount of savings. I need to save hard for the next 3-4 years so that they can buy, like, example, $1 million house when you may be better off buying a $300,000 townhouse in a different state right now.
And so if you're looking at it from that point of view and wanting to buy, because it's for a lot of people, they think, oh, well, it's so hard to save the deposit. But really, in this situation, you really need to get the deposit for the first property. Then once it allows that a couple of years to grow, well, then you've got that for your deposit for your next property. So it really is that. So it is important to get your first deposit. But I know you were talking about before that, well, sometimes you don't actually need to save the standard 20%, which everyone talks about. You also, there is things like insurance and all that you can actually get into a property sooner with a smaller deposit.
Exactly. So as I mentioned about the schemes before, depending on the scheme, Typically, it's around 5% deposit. But as I said, for the single parent scheme, well, then that can be potentially up to 2%. But say if hypothetically you're not eligible for any of the schemes, or say if you aren't part of the first 35,000 or whatever the expectations are, well, then you can ask your bank for lender's mortgage insurance. So if it's a property which you're planning to move into, then banks can potentially do up to 95% lend, but you will have to pay lender's mortgage insurance. Now, what a lot of like other experts may not advise their client is that the 95% lend, so for the insurance, you can either choose to pay it at settlement, or you can choose to add it onto the loan amount. But if you choose to add it onto the loan amount, then that has to be part of the 95% total lend. So that means that your deposit technically won't just be 5%, it might be 6 or 7%, because you've added on the insurance to the actual loan term. So that's something to be wary about as well. But look, some people advocate for lender's mortgage insurance, others don't. I've had some clients where they may have the 20% deposit, but for cash flow purposes, they might want to borrow up to 90% and pay the insurance, because it means that it's actually allowing them to keep a lot more of their cash for a lot more flexibility. So there's so many different options, and that's why it's very important to have a very skilled mortgage broker or have a really good banker. If you choose not to go through a broker, it's very, very important. So yes, there's no really such thing as like a cookie cutter loan structure. So your broker or your banker should be talking with you about various different structures, what like your goals are, and actually recommending a tailored structure to you.
And don't want to get too technical, but there is, as you said, there is so many myriad of different types of loans, and whether you need to get an offset account, or you want a redraw facility, or you want even fixed or variable, depending on what it is. Having someone who actually knows their stuff and can actually advise to what your particular situation need. And I even know people who have said, well, no, I feel like a variable rate might suit, but just for them to the peace of mind to sleep at night, they just want to fix, because then they can know that's going to be that. And so everyone's different. As you said, you got to tailor it. Some of the other expenses people need to pay for, because it's not just saving up the deposit. You've also got things like stamp duty. Is there any other type of things people should know about if they're thinking about buying a property that they've got to pay for?
Yeah, well, if you're a first home buyer, if you buy under a certain threshold, in which the threshold varies state to state, plus whether it's a brand new property or if it's an existing property, if you purchase under the threshold amount, then you actually don't have to pay stamp duty, which is fantastic. Yeah. So for my first property, I was eligible, so I didn't have to pay stamp duty, and then I saved like 20 grand. So if unfortunately you fall outside the threshold, well, then you do have to pay it, but the government is just rolling out this scheme where instead of paying it in lump sum, you actually pay it as annual tax. Now myself and of course, like all the accountants out there are actually trying to find like what are the terms and conditions, like what are the pros and cons. So we're in a phase where we're trying to learn a lot more about that right now. But if you're a first home buyer, if you fall under the threshold, then you don't have to pay stamp duty.
So that's not applying if it was an investment property. You have to live in that property though, don't you?
Well, it has to be claimed as an owner occupied property. So a property that you're moving into. Yeah.
Okay. So now you've just started when we were talking about at the beginning about that you're the property arena, and you're doing some. So just tell us, because I know you really want to help educate people. This is there's so many things to know, and just so to help people equip themselves with as much research and as much information and knowledge, so they know. So tell us more about what you're doing in that space.
Sure. So how this all originated was from a few aspects. So from my time at the bank, I personally have written a lot of first home buyer loans, and I started to notice a reoccurring theme with misconceptions or wrong advice that they may have gotten from family and friends. And then I was like a tape recorder at one point. I was just saying the same things over and over and over. And then like I began to realize, I was like, wow, like maybe this is a very widespread like misconception or myth. And unfortunately, like when people try to do research through Google or YouTube, there are actually a lot of incorrect pieces of information. So property, even though it is popular, even though there are a lot of experts out there, it's just a world filled with misinformation, especially when it comes to bank finance, I find, because I read through a lot of books and stuff as well. So after I started to identify all those issues, I'm an investor myself. So I started very young. I bought my first property at 18. And then since then, I purchased 7 properties by the age of 22. So I'm on track to buy my 8th property. And like I thought to myself that based on all the books I was reading, all the videos, all the seminars that I would attend, it would commonly be people who are 40s plus who bought most of their portfolio in the 1970s, 80s, 90s, when to buy a house, it was what, like $100,000. So, you know, kudos to them for having a big portfolio. But like, I feel that I'm very relatable in terms of, well, when I entered the market, one, I was young. I was only on what, like 55K, wasn't earning that much. And then over the past 4 or 5 years, it's like, well, I've managed to build a multi-million-dollar portfolio with entering the current market. So based on my personal experiences as a young young investor, and plus due to my experiences at the bank, well, that I feel like I love to teach people, I love to help people, but I'm helping people from a relatable point of view, not because I bought all my properties 30, 40 years ago.
And, you know, you just said something pretty mind-blowing, that you know how many properties you own in such a short period of time. My first question or thought would be that is, how would a bank, even though I know you're in the bank, but how would a bank lend on cash flow where you said 50,000? I can see your first property, but how is it going to be the second or third? Or unless you're saying, yep, the cash flow covers that from the rent versus against the loan.
Yeah, well, something that isn't often spoken about in books or other seminars is that there's a lot of focus on cash flow positive properties based on interest only payments. Right. But I would say at least half of my portfolio is positively geared with principal and interest payments. Wow. So for my personal portfolio, I have a mix of interest only and principal and interest, because again, it depends on what your long-term strategy is, whether you buy to hold, buy to flip, what properties you choose to sell or keep short-term or long-term. So because my properties were that heavily positively cash flowed, when you even consider principal and interest payments, well, then that put me in a really good cash flow position, plus also equity growth. So like I just knew the types of areas to buy in, and then over the past few years, well, they've grown so much, and not necessarily due to the boom. So this is another misconception, is that during a boom, all suburbs will increase. That's actually incorrect, because I read this article around the top 100 suburbs which actually declined during the boom. So that's a big misconception, is that just because it booms doesn't mean that your property will boom. So it's just a matter of selecting the property, picking a cash flow rich property, working out what your short and long term strategies are, and I think the golden key here is using that equity to keep on buying more and more properties, which is what I've done. And that's what I like to teach people, is that property actually isn't hard. Once you understand it, well, then it's honestly a world where like you start to love every aspect of it, and you start to become really like obsessed with buying property.
Well, yeah. And and I think you've said a really key thing there. Even properties, there were suburbs in the boom that just didn't go up. So, you know, having the research on finding the right properties that will grow, and also get enough rent so that covers the loan, so that's the cash flow positive part, is just such important research and it'd be great to be able to teach that.
Yeah.
And so, yes, people can contact you on that, but you've also, is in Brisbane, you've got actually a seminar coming up.
Yeah. So next month, so January 2023, we have 2 back-to-back seminars. So one's in Surfers Paradise at the Hilton on Saturday, the 21st of January, and then the other one's in Brisbane Hilton on Sunday, the 22nd. So back to back for all the Queenslanders out there, whether you're a first home buyer or you're looking to invest. With then both my seminars are actually free. So I come on the day. I guarantee that you'll be able to learn something new which you didn't know before. And then after the seminar, you can actually choose to work with me more so directly. But our goal and our focus is to teach you correct information and not to essentially enforce a certain type of property strategy upon you. We will teach you the different types of strategies, and whatever your own goals are or whatever your financial situation is, because you're educated on everything, then you can make your own choice. And I think that's a big key factor, is not to do a strategy because you see some other millionaire do that particular type of strategy. You need to do what suits you.
Yeah, I think that's what. And this podcast isn't usually advertise but I think, what you're talking about, the education and knowledge you're going to impart on people who are, there's no one I meet that doesn't say that they're interested in property, doesn't matter what age they are. And I just think that's such a valuable thing, because you're right. There's so misconceptions out there and myths about what you should do, and every uncle or every auntie say, I did it this way, you should do it this way. And it's just, no, you need to have something that, you need to get up to date with your knowledge, and don't just use Dr. Google. You do need to get it from people who know their stuff. So no, Arena, this has been really, really fascinating. It's been really informative, and definitely, I thought I knew a fair bit about property, but you've definitely told me a few things today that I didn't know. So thank you so much for that.
All good.
And I just, and really best of luck with those events. God, this podcast will come out in January, so it'll be this month. So if you're hearing about this, definitely tell people who may be in those areas about this, get the word out. But one thing I always like to finish off every podcast is to ask you, you've given us great pieces of advice, but what's the best piece of advice you've ever been taught?
The best piece of advice I would say is hear people, but don't choose to listen to everyone, because you will get 100 different types of advice about one situation. People think that they know everything about something, but be a selective listener. Sometimes you need to say no to people. So hear everything, but choose what you listen to.
I love it. That's really great, and a great point to finish on. Arena, thank you very much for your time, and best of luck with your property arena and your upcoming seminars.
Thank you so much. Thank you for your time.
I hope you've enjoyed this episode. If you'd like to know more about Arena McLellan, the property arena, or the free seminar that's coming up, visit Linktree/the property arena. Linktree, that's linktr.ee/the property arena. And as always, feel free to email me on admin@themoneysandwich.com or visit our website, themoneysandwich.com, if you have any questions or would like to learn more. Thank you. Enjoyed this episode and want to hear more of A Bite from the Money Sandwich? Make sure you subscribe on your platform of choice so you can automatically receive each episode as soon as it's released. As with every podcast, this information is not advice, as not personalized to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.